Hello everyone, welcome to the 136th episode of me learning how to trade in Forex. So in the last episode we went through what is an order. Basically an order is simply an instruction to buy or sell an asset. We looked through market orders and limit orders. So a market order or market orders are orders that has been executed. No wait, I did not read that right. So market orders are if you want to just basically do a trade immediately at the best price available. A market order is the one to go. So if the market is liquid enough, your market order will be executed immediately. It's important to be aware that market orders can be filled at worse price than the current bid-ask price. And then we also learned about limit orders. So limit orders are used when you want to wait for a price to reach a certain variable level before you trade. That's when you use a limit order. So a limit order is an instruction to trade if a market's price reaches a particular level that's more favorable than the current price. Went through this question and went through a lesson summary as well. So now we're on to using stop orders. So using stop orders. Date is a 15. So using stop orders. In contrast to limit order, a stop order is an instruction to trade when the market hits a level less favorable than the current price. Why would you want to trade at the worst price? Well, perhaps the most important reason is to close a position that's moving against you. To do this, you attach a stop order to the trade. Then at a point beyond which the level of loss will be unacceptable to you, your stop will pull the plug and close out the position. So a stop order is used to trade when the market hits a level less favorable than the current price. As we'll explain in the next lesson, when markets are moving very fast, it may not be possible to close a position until the price has already passed the level you set. But certainly the stop will give you some protection against escalating losses. Because it helps restrict your losses, this type of stop order is known as a stop loss. Here's how it works. Example. Let's say you own 100 shares of ABC Inc. which you bought as $37, and now the price declined to $35. You hope this is just a temporary move, but you decide if the price should fall as far as $32, it will be time to cut your losses. You place a stop loss at $32. Unfortunately, the price keeps sliding all the way down to $27. However, your stop loss is triggered at $32 and your position is closed. You've lost $500 because it's 100 shares of losing $5 from 37 to 32. But without your stop loss, you would have been looking at $1,000 plus loss. You can also use a stop order to open a new position, known as a stop entry order. Placing an order to open a trade at the worst price than the current price may seem very strange, but sometimes it can make good sense. For example, analysis might suggest that if the market hits a certain level, it will carry on moving in the same direction. By setting a stop order at such a level, you would be ready to open a position and potentially take advantage of its momentum. I did not know that was a stop entry order. So entry order is used to open a new position. Question. Let's say silver is currently trading at $19 and has been hovering around this price for a while. Your analysis indicates that 19.5 is a significant level for the metal, so if it bursts through this level, it will tend to keep moving upwards. You decide to buy silver if it reaches 19.8, as this will mean it has clearly broken through the 19.5 level. How do you set up this trade? You place a limit order, entry order at 19.8. Never mind, stop entry. As you want to buy at a worse price than the current price. Wait. Limit entry. As you want to buy at a worse price than the current price, you need to place a stop order. Worse price than the current price. But how is it worse if it's going up though? Or is it worse just because it's higher? Your order will be executed when the price reaches 19.8. If your prediction is correct, the market will keep rising from this point and earn your profit on the trade. If this happens, you might argue that you could have simply bought immediately with a market order of $19 and made a greater profit. However, by using a stop order, you waited until the market had given a clear positive signal, giving you more confidence in its potential future direction. As you want to buy at a worse price than the current price. So it's 19.8 is worse than 19. Okay. Limit entry. What's a limit entry order then? Limit orders. When you want to wait until the price has reached a more favourable level before you trade. I thought, okay. As you want to buy at a worse price than the current price. Right, I still don't really get how 19.8 is worse than 19 if you think it will go up. Isn't that good? Because it shows that it is going up, so it's positive. Because it goes in line with your analysis. Oh, I don't know. Moving on. Trailing stops. A trailing stop is a special type of stop loss. It not only caps losses, but also helps protect any profits you make. Like other stop losses, a trailing stop is attached to the trade. If the market price moves in your favour by a specific amount known as a step, the trailing stop copies this movement. So it keeps its distance from the current price, but step by step it gets closer to the price at which you opened your trades, and may pass it if the favourable movement continues. A trailing stop copies the market price movement. However, if the market then turns against you, the trailing stop stays put. This means it can close your position at a more favourable level than a standard stationary stop loss would have done, potentially while still in profits. Copies the market price movement. To cap losses and also protects profits. So the trailing stop will only move if the trade is if the market condition is favourable to you. If it's not favourable to you, it won't move. Suppose you decide to go short on USD JPY at 117.6. You set a trailing stop 30 pips away at 117.90. You choose a step size of 10 pips. The market initially drops 5 pips. As this is less than a step size, your stop stays at 117.9. The price then drops a further 5 pips to 117.5, triggering your stop to move down to 117.8. A little later, USD JPY is sunk to 117.1. Your stop has followed it and is at 117.4. However, now the market trend reverses and the price raises to 117.5. Your stop remains at 117.4, so your position is closed as the price passes through this level. Yeah, the stop has protected a profit of 20 pips for you. However, it's worth noting that if the market's upward movement turns out to be temporary, you may have missed an opportunity for greater profit by closing position now. As with other stop losses, a trailing stop doesn't guarantee that your position will be closed at exactly the level you set. Later in this course, we'll explain how you can protect yourself further against loss by using guaranteed stops. Lesson summary. A stop order is an instruction to trade if a market price reaches a particular level less favourable than the current price. Attaching a stop loss to an existing position will restrict your losses if the market moves against you. You can use a stop entry order to open a new position if a market hits a significant price level that indicates a potential trading opportunity. Can you use stop entry to open new? A trailing stop is a special type of stop loss that moves in tandem with favourable changes in the market price, helping to safeguard your profits. Favourable market price movements to cap losses and also protect profits. Yep. So let me just put a stop loss order will restrict your losses if the market moves against you. Cool. How are orders executed? Executed, not excited. Yep, that. So, when you place an order to trade, your broker or trading provider should attempt to fill it according to your requirements. However, variable market conditions means that it's not always possible to execute order exactly as you hoped. To see how and why this can happen, it's necessary to understand the process of your order goes through after you place it. How are orders executed? When you place a market order or when a stop or limit order is triggered, your broker or trading provider will immediately look for corresponding orders in the market to match yours. So if you want to buy 100 shares in ABC PLC at 250p, a seller who has placed an order for at least 100 shares of that price will need to be found. If there are no orders available in sufficient size at the price level you want, your order can't be filled as it stands, unless the broker decides to trade with you from its own inventory. Ah, right, okay, so your broker basically is the middleman to find between you, the buyer, and another seller out there in the world. So your broker basically facilitates the trade between you two. To cater for this situation, which can be quite common in less liquid markets, you can often choose to have your order classified in various ways. For example, if you selected a fill or kill order, the broker must fill it immediately in its entirety, or cancel it. Alternatively, an execute and eliminate order will be filled as far as possible at the price you specify, then any remaining part of the order will be cancelled. I didn't know that's a thing. Right, so when you place any order, your broker will immediately look for corresponding orders in the market to match yours. Yep. To cater for this situation, which can be quite common in less liquid markets, you can often choose to have your order classified in various ways. So, your order can be classified as fill or kill order. The broker must fill it immediately in its entirety, or cancel it, or execute and eliminate order. The broker will fill the order as far as possible at the price you specify, not satisfy, specify and cancel the remaining part of the order. Cancel any remaining part of the order. Market order execution. As we saw earlier, a market order is an order to deal at the best price currently available, with execution guaranteed if there's sufficient liquidity in the market. So if you're using this type of order, your broker will source the closest possible deal to the one you want. This might involve filling part of your order at the price you selected and the remainder at the next best price and on offer. Question: orders from sellers. Number of orders, shares, price, pence. Okay. Tom wants to buy 500 shares in ZXY PLC. He sees that the ask price is quoted 175 pence, and he places a market order. The current order book, the list of orders on the exchange for ZXY PLC is shown in the table above. How is Tom's orders filled? 500 shares, so 150 plus 200 is 350. 350 plus 150 from that to get 500. So 500 shares at nope. 150 shares at 17.5. Remainder of the order not filled. Wait, Tom wants to buy a market order. That. As there are only 150 shares available at 175 pence, Tom's broker uses these to fill part of his order, then makes up the remainder from the next best prices available in the order book. It's worth noting that this can make a substantial difference to the overall cost of the trade. If Tom's order hadn't been a market order, it could have been a partially filled with 150 shares at 175 pence. The rest of the order might have been left working, waiting for more sellers to enter the market at that price or cancelled. Fortunately for major markets, there are usually large volumes of traders looking to buy and sell at any given time. However, if you're dealing in less liquid market or in a very large size, you're more likely to experience difficulty in getting the price you want. Order execution. Depending on the market liquidity, your broker will source the closest possible deal to the one you want, and this might involve filling parts of the order at the price you've asked for and the remainder at the next best price on offer. Cool. So fortunately for major markets, there are usually large volumes of traders looking to buy and sell at any given time. However, if you're dealing in a less liquid market or in a very large size, you're more likely to experience difficulty in getting the price you want. Order duration. Suppose you place an order today to buy gold if the price rises by $100 from its current level. If the metal failed to hit that price until a date in a year's time, it's probably fair to say that you won't want your orders to be filled automatically. Many factors affecting your decisions to trade could have changed by then, not least that you might have got tired of waiting and invested your funds elsewhere. For this reason, you can normally set the duration for an order, after which it will be cancelled. Here are some of the main classes of order you can choose. Oh, I've been through this before. Order duration. Types. Good till cancelled. Order remains valid until you cancel it yourself, or the order is filled. On some exchanges, the order may only be valid for a specified period, so it may be worth checking with your broker. Order remains valid until you cancel it yourself or the order is filled. Good for the day. Order remains active until the end of the trading day on which you place it. Check with your broker to see when your chosen market closes. Remains active until the end of the trading day on which you place it. Good till date/time. You must select a date and time when you want your order to be cancelled if it hasn't been filled. You must select a date and time when you want your order to be cancelled if it hasn't been filled. Fill or kill. If the order can't be filled in full immediately, it will be cancelled. If the order can't be filled in immediately, in full, immediately, it will be cancelled. Execute and eliminate. As much of the order as possible will be filled at the price you specify. Any remaining part of the order will be cancelled. As much of the order as possible will be filled at the price you specify. The remaining order will be cancelled. Parts of the order will be cancelled. Cool. Lesson summary. For an order to be filled, there must be sufficient buyers or sellers in the market to take the other side of your trade. In certain circumstances, your order may not be executed exactly as you specified. If a market order can't be filled at desired price, it will be executed at the next best available prices. You can normally set a duration for your order, after which it will be cancelled. Cool. So how are orders placed? How are orders placed? Oh, priced. Can't read. For assets that are trading on exchange, such as shares, your broker will have access to each exchange's order book, the list of buyers and sellers currently placing orders. The order book displays the price and size of each order, so it's easy to see where your order should be placed. As well as the primary exchanges, such as the London Stock Exchange or the New York Stock Exchange, there are also a number of multilateral trading facilities which accept orders and quote prices on certain stocks. They sometimes offer better prices than the primary exchanges, although not all brokers are able to access them. Prices offered by the primary exchanges and MTFs are publicly visible and are known as lit books. However, prices hidden in the dark liquidity pools can also be available for you to trade against, if your broker has access to them. Dark liquidity pool. Participants in dark pools are generally institutional investors who don't want to reveal the price, size and origin of their orders. For over-the-counter markets such as Forex, prices are sourced from the network of global banks and liquidity providers participating in the markets. Hidden in the dark liquidity pools can also be available for you to trade against. So is this like a hidden pile of like trades which are used if there are no other trades to go against yours? So then your broker has access to these, like, I guess, reserve liquidity pools to use against you if you do decide to do a trade which no one else does the opposite of your trades, which no one else has that is the opposite of your trade, right? Something like that. Participants in dark pool generally institute who don't want to reveal the price, size and origin of their orders. So they're pretty much massive orders basically. They can't be small orders, right? They must be like really big. Yep, slippage. Another issue that can affect the price at which your order is executed is slippage. Prices can change in a matter of milliseconds, and between the moment when you click to place an order to the point where your broker receives it, your intended price might become unavailable. If you're using a market order, it will be executed at the best price your broker can get. This could be substantially worse than the price you expected if markets are volatile and moving rapidly, perhaps after a startling news event or an unexpectedly poor company earnings report. You're most likely to see the impact of slippage when you left a stop-loss order to close position in the event of an adverse market movement. Sometimes prices may change so fast that it's impossible to close your trade at the level where you set your stop. So prices can change in a matter of milliseconds, and between the moment your price, so if you use a market order, perhaps after starting news event, you're most likely to see the impact of slippage when you left a stop-loss order to close some position in an event of an adverse market movement. Sometimes prices may be changing so fast that it's possible to close your trade at the level where you set your stop. Right, okay, so slippage occurs when the price at which you place your order doesn't match up with the price your broker. Slippage occurs when the price at which you place your order at doesn't match up with the price your broker fulfills it at. Example. Say you take a long position on the Dow Jones Industrial Average Index at 17,838 with a stop at 17,699. A couple of influential Wall Street firms then report unexpectedly poor earnings. This causes a drop in the other Dow constituent stocks, and the index tumbles through your stop. As soon as the price meets your stop level, your stop order is triggered. Here's a table showing how the price quoted by your broker moves in the moments before and after your trade is hit. Your stop is hit. So your stop is here. The price went boom, 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 hit here. 4 points in slippage. Execute the stop. Your actual stop only is at here. So there's a 4-point difference between your intended stop and your actual stop. So time, London, 21:10:33. That's somewhere about here. 21:10:36. So it's these 3 times that's important between what occurred here and here. Dow Jones price 21:10:33, 21:10:36. So that's buy order, that's a sell order, right? Because sell buy. So you place at 17,699. Between these times, 17,699, 17,695. You can see that the bid price reaches your chosen stop level at 17,699 at 21.10.33 in blue. This is when your stop order is triggered, but it's executed at next available price of 17,695 at 21.10.36 in green. This means you have paid 4 points in a slippage, but are protected from the rest of the price drop. Right, okay. Guaranteed stops. If the risk of slippage feels a little worrying, there is an answer. You can use a guaranteed stop. A guaranteed stop works in the same way as a standard stop loss, except that it will always be filled exactly the level you set. Effectively, the broker or trading provider takes on the risk of slippage for you. Naturally, they may require a fee for this additional service, and this can come in the form of a wider spread. Attaching a guaranteed stop puts an absolute limit on your potential loss, and this can be reassuring when you're trading in volatile market or in large sizes. So, a guaranteed stop will always be filled at the exact price level you set. The broker may require a fee for this, which can come in the form of a wider spread. Attaching a guarantee stop puts an absolute limit on your potential loss, and this can be reassuring when you're trading in volatile markets or in large sizes. Yep. Lesson summary. For assets that are traded on exchange, prices are sourced from an order book. For assets traded over the counter, prices are sourced from providers participating in the markets. Slippage occurs when the markets are moving rapidly and the price you want becomes unavailable by the time your order is executed. You can put an absolute cap on your losses by using a guaranteed stop, although there will be a charge for doing so. For assets that are traded on an exchange, prices are sourced from an order book. For assets that are traded over the counter, prices are sourced from providers participating in the market. So, what is leverage? The clue is in the name. Just as a mechanical lever helps you move a heavy load with only a small amount of force, leveraging enables you to gain large exposure to a financial asset using only a small amount of your trading capital. Leverage enables you to gain a large exposure to a financial asset using only a small amount of your trading capital. When you buy an asset in the traditional way, you generally need to pay the full purchase price up front, the total value of the shares, currency, barrels of oil, or whatever you're trading. However, some providers offer the facility to trade using leverage, which means you only have to put up a fraction of your value. Wait, you only have to put up a fraction of the value of your position. Effectively, a provider lends you the rest of the purchase price. This means that any profit you make, which is still based on the full value of the position, appears magnified in comparison to your outlay. The flip side of this is that any losses are magnified in the same way. With leverage, both your profit and any losses can actually exceed your initial outlay. With leverage, both profit and losses can exceed your initial outlay. Did you know leverage is also known as gearing or geared trading in some countries, such as the UK and Australia? Huh. How does it work? Let's look at an example to illustrate this. Suppose you decide to buy 1,000 shares in tech giant Inc. The share price is $1. So to open a conventional trade with a stockbroker, you pay 1,000 times $1, which is $1,000. We'll ignore any commission or other charges to keep this example simple. Alternatively, you could decide to trade using a provider that offers leverage facilities. The provider will ask you to pay just a percentage of the full $1,000 to open your trade. This is known as a margin or deposit requirement, and the actual percentage will vary from asset to asset and from provider to provider. Say your provider has set the margin requirement for Tech Giant Inc. at 10%. This means you need to pay only 10% times $1,000, which is $100, to open your position. You still have exposure to 1,000 shares, but only a tenth of the initial cost. Magnify profit and losses. Now let's see what happens as your Tech Giant Inc. trade progresses. Your decision to buy these shares was shrewd as the price now climbs to $1.2. You sell to close your trade for $1.2 times 1,000, which is $1,200, giving you a profit of $200. Compare your profit to initial outlay if you used conventional trading. Initial outlay $1,000, profit $200. And now with leverage trading, initial outlay $100, profit is $200. The leverage trading is giving you a 200% profit, whereas the return for the conventional trade is just 20%. However, take a moment to consider if, instead of rising, Tech Giant Inc. fallen by 20 cents, giving you a $200 loss, the leverage trade would have resulted in a loss twice the size of your deposit. It's vital to prepare yourself for situations like this by always keeping in mind the full value of your trades and the potential for loss when using leverage. This is particularly true in markets such as Forex, where you deal in lots that can each be worth thousands of units of currency. At the same time, margin rates can be very low. Always keep in mind the full value of your trade and the potential losses when using leverage. This is particularly true in markets such as Forex, when you deal in lots that can each be worth thousands of units of currency. At the same time, margin rates can be very low. So if you were to sell just one standard lot for 100,000 units of Euro USD at 1.291, the contract value would be $129,100, with a potential margin requirement of just 0.5%. Your deposit for this very substantial trade would only be $645.50. It's easy to forget how much capital is at risk when the initial outlay is so affordable. True. You decide to open a leverage position buying 1,000 shares in Monster Mining Conglomerate PLC, currently priced at 100p per share. Your provided margin requirements for Monster Mining Conglomerate PLC is 5%. What's your maximum possible loss on the position, assuming you don't use a stop loss, and how much margin must you pay? So margin is easy to work out. 1,000 shares at 100 pence per share. So that's let me get a calculator out. 1,000 times 100 is that 100,000 times by 0.05. So 5,000 is the margin. Oh no, 5,000 pence is the margin, divided by 100, £50 margin. Possible loss, what's your maximum possible loss? So maximum possible loss is the share price dropped to 0. So if it drops to 0, then 1,000 times 100 divided by 100, £1,000 loss. Your maximum loss is the full value of the shares, £1,000, if Monster Mining Conglomerate PLC fails and the stock drops to 0. Your margin payment is just the 5% of the full value, which is £50. Nice. So the cost of using leverage. To keep things simple, in the examples above, we've ignored any charges and commissions that you might pay as part of the normal trading process. It's worth mentioning one cost that you could sometimes see when using leverage though. It's worth mentioning one cost that you could sometimes see when using leverage though. Since you don't put up the full value report position when you trade with leverage, this means your trading provider is effectively lending you the balance of the money. For this reason, they may take a small charge to reflect their costs when you keep a trade open overnight. This is called an overnight funding charge. It varies between different products and providers. So keep an eye out for it in terms and conditions. For this reason, they may make a small charge to reflect their costs when you keep a trade overnight. Lesson summary. Leverage enables you to gain large exposure to a financial asset using a small amount of your trading capital. You need only put up a fraction of the full value of position, known as a margin or deposit payment, with the provider effectively lending you the balance. Leverage magnifies both profits and losses, and these can exceed your initial outlay. It's important to keep in mind the full value of your trade and its potential for losses when using leverage. Overnight funding charge is your broker making a small charge to reflect their losses when you keep a leveraged trade open overnight. Cool. I am going to leave this episode here. So in the next video, we're going to go through margin calls. So thank you for watching, and I will see you guys in the next video. Bye bye.